Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm here with Steve Farrar, and if you're watching on video, you can see the name Todd there, but Todd's camera is not working. We're having some technical difficulty. Anyway, guys, good to see you. We're going to be doing a podcast on the quarterly NCUA data that came out a couple weeks back. We kind of got into a routine of updating the listeners and watchers on what's going on in the credit union data every 3 months. And they got next week, they're doing their briefing on the CAMELS ratings, and I'll be watching for that one. Some other things going on at NCUA. The new board member is supposed to get his confirmation hearing next Thursday. There's a board meeting next Thursday, as I mentioned. By the time this comes out, that may have already passed. So I'm going to stop talking about what's happening next week. But with that, if just in case there's a new listener who hasn't seen us before or listened to us before, if you could give a little bit of your background. Let's start with Todd this time, down there in black and white.
Good morning, everyone. So I've spent 34 years with NCUA. I can break that career and my time with NCUA into three general groups. The first third of my career, I was an examiner and a problem case officer in the Western region. Then the middle third of my career, I spent roughly a decade as a regional capital market specialist in the Western region, of course, dealing with large and complex credit unions. And then the last 11 years of my career, I was the director of special actions in the Western region, supervising problem case officer, regional capital market specialist, regional lending specialist. Very fun part of my career. Was involved in a lot of complex credit unions, did a few conservatorships, returned a couple to the members. Those are kind of highlights of the career when you can do that. And there's a lot of those instances, well, you end up liquidating them or doing purchase and assumption or system mergers. So was kind of involved in all of that stuff. All in all, enjoyed my 34 years with NCUA. It is very enjoyable working with Cardine that entire time. Good people at NCUA to work with as well.
Very good, very good. And now we've been doing this 5-6 years. And Steve, give us a little bit of your background then and now.
Oh, I'm gonna tell you what my background behind me there is. It's a mountain lake. I'm not at this mountain lake, but I'm one just about like at night. We literally ran off of the boat to get up in time to do this thing. So I tell her, I would say this morning, I probably caught 10 pounds worth of fish, but I never kept a single one. They were all pretty little. Lapping activity, so that was fun.
That's good. That's better than the amount of fish you and I caught when I came through Montana.
Yeah, but you guys went through a lot of bobbers.
Well, yeah. Well, it's not. I tend to do that.
So my career at NCUA was 30 plus years, broke into two parts. First half was predominantly as a problem case officer and did a lot of work with Todd, and that we helped the troubled institutions primarily out on the West Coast, and a lot of satisfaction from that job and getting those turnarounds to be successful, and many of them are still around today. Todd and I like to talk about that we were able to save credit unions with even negative capital back in the day. Then I followed Mark when he went to the central office and went to work for the Division of Risk Management, where I spent another 15 years basically. And in that job, I got to work in just so many different things. I dealt with a lot of the accounting for the insurance fund. And then we're still involved in all of the major problem credit unions, including the corporate system. Todd and I both worked a lot of time on that. And that was an interesting part of our career that wasn't exactly the most enjoyable, but necessary. And then I ended as the vice president of the CLF when I actually went and moved back to Alexandria, Virginia for a few years. And then we've been doing this consulting now for quite a while, and that's been super enjoyable to be able to keep active in the industry and keep our saws sharp.
Yeah, no, it is a lot of fun, and I always enjoy chatting with you guys about what's going on, and looking forward to seeing what we got to say about the March 31, 2026 data. So with that, is there one particular thing, or either of you want to kind of jump in first? Do we want to walk through the camel from a capital, asset quality, earnings, liquidity? How do we want to approach this one, guys?
Maybe a little background before we start, just to kind of what's going on with conditions.
You got
What you'll find as we go through this podcast, there hasn't been a lot of changes other than credit unions' performance has improved a little bit. Inflation is still persistent. Interest rates have been fairly stable. The short end was inverted a year ago. It's kind of normal now. Longer term rates have went up 50 basis points or so, but in general, there hasn't been a lot of changes to interest rate. Inflation has been fairly persistent. The Fed can't seem to get that under control, but despite that, credit quality is holding up. Wages are growing about the same as inflation, not quite as much. Unemployment trends are kind of all over the place. I use a Fred tool from the Federal Reserve just to track a lot of data. And one of those things I track is unemployment in all 50 states every month. In the last year, we have 31 states where unemployment is higher, 15 states it's lower. Somewhat interesting, along with the whole government reduction in forces, the District of Columbia has got the highest unemployment rate in the country right now at 6.2%. And then the other places where you see high unemployment is kind of the tech sector. California, Washington, Oregon, those tech hotspots all have unemployment numbers over 5%. A little bit in Michigan, that way too, in a couple other states. South Dakota's got the lowest at 2.2%. Savings rate,
but South Dakota only has 74 people. No, I'm just kidding.
we've got like 174. Come on. They get a couple thousand when they have the motorcycle rally.
That's right, Sturgis. That's right.
Sturgis. Things are fairly the same. Things are kind of moving around at state to state level. But in general, country's been pretty resilient, even though inflation is a little high. I do know it. All three of my vehicles, it takes $50 to fill up the gas tanks now. You kind of notice it when it crosses over that $50 a tank mark. But for the most part, credit unions have held up well. Earnings are improving. Despite the fact we're in a shooting war and inflation is quite high, our economy seems to be fairly resilient.
Steve, from that 10,000 foot level, walking through that data, any thoughts on that?
Yeah, Todd and I shared it when we first looked at this data when it came out. It was like nothing really changed. Liquidity seemed to improve just a little bit, but this quarter was uneventful. No real glaring negative trend jumping out. I did my usual comparison to the community banks.
Yeah.
And we still have the same. The competitive disadvantage that credit unions have against the community banks is the loan losses continue to be significantly higher than they are in the community banks. Their net charge-off ratio is very low, and it went lower. It's down to 0.18%. And the credit union's net charge-off ratio was, I'd say, have 0.78 written down. So that is and it gets reflected in the provision expense that the losses are higher, and that's kind of a competitive disadvantage that we have when you compare it against the community banks right now, because they were really strong in profit. Their pre-tax return on assets was 1.42%, which is higher than it was in the fourth quarter, and the credit unions were 0.83. So, but when I read summaries of that, they point out that the banks have higher earnings because they were more driven for that, of course. But credit unions have much more in terms of growth of members, and then and more growth in loans than they're seeing in those. So both have some good things going for them.
Well, when you talk about the loan losses, I guess if I was trying to figure out a glass half full, maybe it's because credit unions are trying to meet their purpose of serving people of modest means. Maybe not. I don't know. But that's an interesting stat. Todd, do you have any thoughts on that?
I think credit unions have always had slightly higher charge-off ratios than banks, with a bit more liberal lending type of policies across the industry. So that's not unusual. I don't know if you have it at your fingertips, Steve, but usually the FDIC used to publish a percentage of credit union or banks that are negative earnings. You have to dig for it at NCUA and do a custom query. That may be one negative spot in the credit industry. There's 639 credits or negative earnings here in the first quarter. That's a pretty big number out of 4,250 credit unions.
So what percent is that? They're around
That
Oh,
15.
I have it written down here somewhere, Steve. I don't know where I have it written down.
I'm gonna pull out my. I'm gonna guess that it's 15%. Let's see if I'm right.
Yeah,
15%.
yeah. The percent of unprofitable community banks was 4.98%. So basically 5%. It's a little lower than it was that year in fourth quarter. So yeah.
And a lot of those.
For credit unions, it's up. By a way of comparison, I pulled this when we did our podcast at the end of the year. At year end, there was 498 negative credit unions, and now there's 630. 18 of those are over $1 billion. 18 are 500 and $1 billion. So not very many negative earners at the larger size. 523 of that 639 now are credit unions under 100.
Yeah,
There's a lot of small credit out there that are at negative earnings.
they're treading the water until the CEO retires, and then probably merge. A lot of those.
So that's a big number that changed. Is look at intangible assets and equity acquired in mergers. That took a huge jump in the first quarter of this year. There had to be a very large mega merger or two or three that closed here in the first quarter because those numbers went up quite a bit.
Yeah, that's interesting. I've got some data analysis. I was getting ready to do on mergers. I'll have to make a note of that and take a look at that. Yeah, that phantom equity, right? That equity that per GAAP accounts as equity, but it doesn't have a whole lot of tangible value.
It went from 9.2 to $11.9 billion, so 28% increase in one quarter.
That's an alarming number. I'm definitely going to dig into that. That's huge. That's huge. So the topic of capital, some of that equity related to those mergers. Any other thoughts or any thoughts in general on capital? As we're walking through what's happening.
So if you go dig around NCUA's website, they put out a chart pack with each of these quarters. I don't know, there's 20, 30 graphs in them. One of them is net worth ratios and percentage of net worth ratios. Capital-wise, 98.5% of our credit unions are above 7%. And there's not a lot of credit unions subject to PCA. 64 of them in the whole country is all out of 4,250. So capital-wise, the industry looks really good, and there's not a lot of credit unions out there subject to net worth restoration plans or prompt corrective action at the moment. I think there was probably a time when I was the director of special actions, we had more than that just in our region.
Yeah, no, I think you're right. Steve, any thoughts on capital?
Not really. We're staying pretty steady on that and real comparable to what you see in capital in the community with the community banks. I think so. It is interesting when you talk about those 64 in PCAs, because as the industry, the numbers look really good and solid and kind of repeating itself this between one quarter and the next. But we do know that there are those individual institutions that are that facing problems. I don't think that's any one thing. I think, it's just something inside of, what their kind of core business ended up being has deteriorated or something like that. Some of them could have been where they tried something new and are having negative results and working through it. But I don't see any common trend in why the credit unions end up into a kind of the PCA situation. I mean, usually it's loan losses, right?
No.
And it's that usually it comes down to, it could always be for a few big frauds, which we know occurred and affected the industry recently. So, but I can't find Here's the one thing it always comes down to, are you granting decent loans, and can you stay out of trouble? You see the ones that end up with poor liquidity, and when they try to cover that, sometimes they make bad decisions trying to fix liquidity that affects their profitability. So it's those well thought out plans are still super important.
Well, Todd, Steve brought up liquidity. Any thought with your 10 years as a capital market specialist and another 10 years supervising capital market specialist, any thoughts on what you saw on the liquidity front?
There was incremental improvements. Borrowed money is kind of paid down a little bit across the industry. Non-member deposits are down. Or we see a lot of credit unions offering money market accounts to kind of capture some of that certificate money. I think people are uncertain, so you see a little bit more money going into money markets as opposed to certificates. Given the inflation and everything else, I'm actually surprised that the credit unions could grow as much as they did. I mean, share growth was 10% this quarter. I mean, that was a healthy share growth number. And loans, of course, grew a lot slower. They only grew at 4%. So actually 1%. So you got 10% share growth and 1% loan growth. Liquidity tends to improve. Credit unions didn't invest long. They're in a nice spread between short-term rates and what they're paying on cost of funds. Cost of funds was dropped a little bit this quarter. Credit unions are still improving their net interest margin. So liquidity just improved, not by a lot, but it was incrementally improved across the industry. It should the NCUA to take their eyes off of that and focus on a few other things. So I expect that will continue to probably improve.
That all sounds good. Before we started, I've got this little tool I've built where I can analyze some of the 5300 data, and I asked I dug into the delinquency side of things. I'm gonna read off a couple of stats I've got here and see what it triggers for you guys, if anything. So the key takeaways that my questions drove for March was that total delinquency dropped 19.7% quarter over quarter from 13 to 10.5 billion. And the overall delinquency rate fell from 65.5 basis points to 60.5 basis points, which is the first meaningful decline since at least 2022, but that hasn't been uniform. Consumer and residential got better. Used vehicle delinquency dropped 27%, the single largest decline in dollar terms. First lien residential real estate dropped 34%, biggest absolute drop, though this category is volatile and may reflect seasonal cure patterns in Q1. New vehicle delinquency was down 26%, credit cards down 13%, which conflicts with some things that we heard in a call the other day. Other unsecured loans down 10%. So all of those categories collectively were down 2.6 billion. What's going the other way, the one category I didn't mention yet, is commercial. CRE construction and development up 42%, the steepest percentage increase in any category. CRE non-owner occupied up 7.4%, continues a relentless climb from 86 in 2022 to 861 million now. CRE multifamily up 3.2%, been rising for 4 straight years. Ag production, agricultural loans, 13%. It's a small number, but that number's up. Commercial non-accruals rose over 2 billion, up 5%, even though delinquency in total fell. The composition shift tells the real story. Commercial real estate share of total delinquency jumped from 11.5 to 15.1%. In one quarter, residential real estate went from 50% to 44%, and consumer held steady at about 33%, which would not have gone down, I guess, because of the growth, right? So if the denominator's changing, that's where you would make up that number. Follow-up question I asked tied to that, circled back to CRE construction and development. 2022 was at 26 million. Next year, 45 million. Next year, 2024, 112 million. 2025, 121 million. March, 171 million. So the commercial stuff, is not going in the right direction, which is when I think back over the years, there's the office buildings, causing issues, but it's kind of crept into almost every type of commercial. Any of those numbers I threw out there attract your attention, make you come to any conclusions?
Didn't surprise me at all. But I mean, the credit card one is interesting because, like you said, we keep hearing it. I mean, credit card is a pretty good in the community banks.
Yeah. And Todd and I heard that in a call the other day that it's up, and we haven't seen credit cards up in our conversations with clients generally, but I've heard that stat. Todd?
Outside of the commercial loans, if you go back 1 year, you've seen steady increases in delinquency in the second, third, fourth quarters of 2025. And we ended up March of 2026, just about exactly where we were in March of 2025. So over the year, we had some increases and then it dropped down.
Yeah.
Every category, not the commercial. The commercial loans, it's kind of interesting. Like I read, delinquents or unemployment numbers are very widely over the course of the country, from 2.2 to as high as 6.2. Commercial loans and real estate loans in general are the only loan categories that have consistently been growing over the last decade. So credit unions, we have more and more credit unions getting into commercial lending. They're expanding those portfolios. And there's always a price to pay for experience. You tend to make a few mistakes along the way. So some of this commercial lending delinquency, I suspect it's people gaining some experience in how they're underwriting and servicing those loans. And then the other piece of it, like I said, the dumping variables on unemployment that are so high. And if you look at past recessions, even commercial loan problems that we had during our 30 years of career, they always tend to be geographically isolated. So it makes you wonder if all that rise in commercial delinquency isn't happening maybe in 3 or 4 states, not necessarily uniform across the country. The interesting thing is that you can do custom queries at NCUA and get raw numbers, but you can't do custom queries and get percentages. It'd be nice to actually go get individual credit union commercial loan delinquency percentages and see where they're at. I didn't take the time to calculate it. You can get loans and assets and figure that piece out backwards at an individual credit union level. But I think it's going to be what Steve said just about troubled credit unions in general, that there's no one reason driving it.
Sure.
There are markets where housing prices and commercial real estate values are still high, and there's other places where they're falling. So it'll be interesting to see how that one plays out over time.
Yeah. And is it specific states, and maybe a few, and I didn't dig into the numbers. Are there big credit unions that have big portfolios that are driving those numbers? Steve, sorry, I interrupted you.
That regional differences is really evident in the community bank numbers there. When you look at they break it down with New York, Atlanta, Chicago, Kansas City, Dallas, San Francisco. When you look at multifamily, it's twice as high for the New York East Coast region area there. Their commercial loans are also big differences there, and the New York district in Atlanta, really high. San Francisco's super high on that one. And the interesting one is credit cards varies incredibly wide. You get, for instance, the Atlanta one is only 2%. Kansas City, 13.75%. So that's a huge aberration that you just wouldn't expect. So I think there is, as we talked about, different regions are feeling the impact. And the San Francisco one also has really high credit card delinquency. So
that's not surprising with all the tech layoffs.
Yeah, good point.
But what in the world's going on in Kansas City?
Well, I wonder if some of that isn't just because they have a lot of those credit card banks chartered, like in South Dakota.
I was thinking the same thing on South
Dakota. Which was probably in the Kansas City region. That's just pure speculation on my part.
That would explain that, because it's so huge. It's got to be something odd.
So as we were talking there, I pulled up, let's see, what states, the state data. Well, interesting. Kansas, it says, is the biggest red flag. Commercial delinquency went up from 1.2 to 59.4 in 1 quarter. So as I say that, I go, gosh, someone could probably go look and see which credit union that was at. That's a little precise. Washington State more than doubled. Virginia up from 62 million to 100 million. Florida also went up substantially. And New Hampshire, which doesn't have a lot, from 0 to having some. So that number looks statistically large. So interesting stuff. Any other thoughts on delinquency, asset quality, investments?
As a whole, we'd say asset quality
Is holding.
is pretty good.
Yeah.
We're not worried about it.
Good. All right. So we talked capital, we talked asset quality, we talked earnings from a perspective of the bottom line. We talked earnings from the perspective of provision for loan loss.
Yeah, and earnings, Todd, did you have anything to say on, you and I are always so focused on operating expenses. We can't not talk about operating expenses. What you think is going on there?
Aside from the operating expenses, credit unions, they're still catching up on improving the yields on their loan portfolio, and cost of funds are coming the other way. One of the things that NCUA does in their chart pack is they have a 10-year history of yield on loans, yield on investments, cost of funds. Loan spread at 4.4% over cost of funds is the highest it's been in 10 years. So it's taken credit unions a while to catch up. They got behind during the inflation years in 2022 and stuff, where loan spreads were almost the narrowest they've ever been. Well, now they've generated them back up to the highest they've ever been. It's positive for the credit unions. It looks like they're doing a better job of pricing things. That's probably a piece of why earnings went up. Just interesting observation that those yields are better than they've ever been. Credit unions historically are not necessarily good about watching their marginal yields and marginal cost of funds, but as an industry, they seem to be doing better about it here. Some of this is just catching up from the inflation. Rates went up really quick.
All great points. So anything we missed here, guys? Any stats we typically talk about that we want to, or are we ready to give a final wrap on the quarter? Go ahead, Todd.
Pete mentioned expenses. They're always kind of an important piece of things. The number or the ratio of operating expenses to average assets stayed roughly the same. But when you dig into the expenses, employee compensation and benefits went up 5% in the first quarter. And some of that might be bonuses paid from last year's results, but it was a pretty big jump and well ahead of inflation.
Interesting.
Yeah, and credit unions compared to the community banks, continue to run substantially higher expenses. Well, not substantially higher. The community banks came at it to basically 2.6%, and credit unions are 3.1. So
50 basis points.
That's been there for a while.
Yeah. Very good. All right, guys. Well, good news is good news, right? So the numbers didn't got generally a little bit better, I would say, from the discussion we just had. Next week, NCUA is going to be revealing the CAMEL codes. We recorded another podcast that I haven't launched yet, which is about the changes in the CAMEL letter, but I'm guessing with the data getting a little better that we should see CAMEL ratings getting a little bit better next week as well. So
I'm an executive at NCUA who just went to 25% CAMELS-style. I'm pretty happy that the credit industry's performance are doing well because it buys them some time to adjust
to their new normal. I agree. Yep. And they've got a new board member coming in who's going to want to move, make it his place. So they're going to have some more new challenges. Probably have a couple other retirements coming that of people who Don't want to break in new board members, but we'll have to see how that plays out. Very good, guys. Steve, are you going back out on the boat, or are you done for the day?
We'll probably go back out this evening. Yes. Yeah. Try and catch something worth keeping here. That's the goal now.
And I told my wife I'd come help her weed the garden when this plus chat was over.
Well, Todd, you got to go tell her that you need to go get an external camera before you can weed the garden. Maybe not. Maybe not.
Best Buy is not very far from my house.
Over the weekend, you could get that. So very good, guys. All right. As always, it's fun. We'll be chatting with you, I'm sure, sometime next week on some of our client calls. Guys, thanks for participating, and listeners and watchers. As always, I want to thank you for listening or watching, and hope you'll do the same again soon. This is Mark Treichel signing off with Flying Colors.